Critical 48 hours ahead and what it might mean for this resilient rally. Let's ask our panel. Gabriela Santos is global market strategist for JP Morgan Asset Management. Stephanie Link, Hightower's chief investment strategist and a CNBC contributor. Our own senior economics reporter. He is not a strategist, but he is nonetheless. Steve Leisman. So let's begin the conversation. So, Steve, what a time. What a time for a Fed meeting. We got a new bull market allegedly started. I just wonder what they must be thinking about this now as they sit down at that table starting tomorrow.
Yeah, I'm not sure how happy they would be about the bull market. I think there's a wealth effect issue. I don't think that's the top of the issues that they're concerned with right now. I think what happens, Scott, is unless you get a massive upside surprise on the CPI report, that they do take this pause. They want to see what they've done. I think the chairman has some concerns about the banking issues that are out there. I think he has some concerns about the lagged effects of policy. I think they also may want to give the Treasury a chance to rebuild its coffers, and that creates some stability for the money market funds to perhaps fund that new issuance. So there's three good reasons for the Fed to pause. And he's going to try to dance this dance that's going to say, look, we're not taking it off the table. It's not a skip, because a skip implies we're definitely going to hike. I mean, what he said late last month, Scott, was this is the only forward guidance we're giving you really is that we're looking at the data. And that's where they're at right now. They're going to take a look at it and see if all the things that we talked about just a minute ago are going to be things that are going to help bring inflation back down to the 2% target.
All right, Gabriella, I'm taking a look at the data, and what I see is a NASDAQ 1.25%. I've got the Dow Jones Industrial Average over 34,000 as we speak, and I have the S&P 500 up 0.5%. We're more than 20% off of the lows. I think it surprised you, probably, that we've been as resilient as we have been. What now with these critical events looming?
Yeah, and I think as it pertains to the macro data, what's been really interesting to see is this month's big cyclical rally, right? Cyclical's up 5%. You see that going down the market cap spectrum, so small caps up 7%. And you also see that in rates as well, with the two-year yield up 56 basis points over the last 6 weeks. So I think the prevailing macro narrative going into these data prints is higher chances of a soft landing, slow disinflation in the super core, higher for longer on rates, and the U.S. is doing so much better than everybody else. And I think all of those narratives are a bit fragile. Whether they break this week already or it takes a little bit longer remains to be seen. But ultimately, we see disinflation picking up speed. We see soft landing as unlikely to be a steady state, and recession risk is still elevated. And we see the rest of the world not doing as badly as the headlines suggest.
All right.
Really a critical time here.
Steph, is it time for those who have been, I know you're looking at me like it's a loaded question, and I'm not saying that you've been extraordinarily negative, but is it time for those who have been to put the bear suits back in the closet?
Well, yeah, I mean, it's not going to be an easy, even ride between now and into the end of the year, let's just call it. But the economy is holding up a lot better than expected, and it's holding up because the consumer is doing really well. We talk about it all the time. Look at the Carnival Cruise bookings numbers today. They're off the charts, right? So the consumer's doing well. The job market remains very tight. Wages are still there. It's been the same narrative all year long, and the economy is holding up, and that's helping at least the earnings picture not collapsing, right? So, and that's
helping the everything
important.
picture.
It's helping.
It's helping the everything picture. The stock market picture would not be as pretty as it looks today without what you said.
But what's really interesting is how much growth is outperforming value year to date. Talk about mean reversion, right? I mean, it's incredible. Growth is up 28%, value is up 1%. And the exact same thing happened last year. Value, except it was reversed. Value outperformed growth. So something's got to give, Scott. I think that some of these moves have been really big. I hope we're going to see a broadening out, but we haven't seen it so far.